Okay, let's talk a little bit about depreciation now. So if we buy an asset, let's say a car, we go to the car dealership today and we buy it and it costs us $20,000. In a month or two, which frequently happens to my husband, he'll decide he doesn't really like it as much as he thought he would and he would like to sell it. Well, if we take that $20,000 car back to the dealership, guess what? They're not going to give us $20,000 back. We'd be lucky in many cases to get $16,000 for that basically brand new car. So accountants try to capture that loss of value, and we try to allocate the cost of an asset to over the years in which we are going to receive benefit for that asset. And that's applying the matching principle. So we're going to match the expenses in the same period in which we earn our revenues. And depreciation, that loss of value, is something that we need to capture. So it's going to impact both our balance sheet and our income statement. I'm going to show you it in big bold letters. It says it does not reflect a decline in value, and that's absolutely true because it isn't an accurate adjustment for the loss in value. But we do need to allocate somehow the cost of that asset while we're using it. So the general entry for depreciation is you debit depreciation expense. Remember, expenses increase with debits. And you credit this new account called accumulated depreciation. Now, accumulated depreciation is a contra asset account. So it carries a balance opposite of an asset. So it will carry a credit balance and it will reduce the asset on our balance sheet. So what you'll see on our balance sheet, remember we carry our assets, liabilities, and equity. You'll see the asset, for example, building, and it will be shown at its cost, which in this case is $600,000. And then we will reduce it by the amount of accumulated depreciation, $55,000 on that building. So cost us $600,000. So far, we have accumulated $55,000 worth of depreciation on that building. That would tell me that's a pretty new asset. It hasn't been depreciated very much, so it should have a lot of useful life yet, which is why we keep those two items separate. Also, your building or your asset minus the accumulated depreciation will give us what we call book value. This is what we say the value is of that asset on our books. So our depreciation expense will impact our income statement. Expenses go on our income statement along with our revenues, but that accumulated depreciation account will be shown on our balance sheet. So we have an impact on both locations with depreciation. Now we have a couple different kinds of depreciation methods, straight line methods and accelerated methods. So an accelerated method is going to give you a higher amount of depreciation early on, which in many cases does reflect the loss of value of an asset. It takes a big hit like that car I mentioned earlier, and then if you keep your car for 15 or 20 years, the amount of depreciation on that every year thereafter is minimal. Straight line depreciation methods we'll take a look at as well. So we have straight line, units of production, sum of the year's digits, and declining balance. I'm kind of surprised your author mentioned sum of the year's digits because he doesn't expand on it any further than that. So let's look at how we would do a straight line method. This is used by most companies. It's the easiest to do. And we just take the cost of our asset minus any salvage value. So that's a value that we say it will be worth at the end of its useful life. And it's a guesstimate that accountants use. Sometimes they get some help from other people in making that, but this is one area where they're definitely just making a guess, trying to put something together that looks right, that they think will be right, but there's no for sure with that. And we'll divide it by the useful life in periods. So let's say on January 1st, 2004, equipment was purchased for $50,000 cash. The equipment has an estimated useful life of 5 years and an estimated residual or salvage value of $5,000. We'll take our $50,000 and we will subtract the $5,000 salvage value, and that is going to give us $45,000. And we'll divide that by the 5-year useful life. So $45,000 divided by 5 will give you $9,000 depreciation per year. Under straight line, that depreciation does not change. Once it's calculated, it remains the same unless something happens say we need to revise the salvage or the useful life. So we would debit depreciation expense for $9,000, credit accumulated depreciation equipment $9,000. Something I should mention here as well, that's for an entire year's worth of depreciation. So if we would have purchased this asset on June 1st, we would only be able to take 6 months worth of depreciation, so we would have to multiply that times 6/12. So you have to pay attention to those dates, because we do prorate depreciation based on the length of time it's outstanding during the year. So here's, and you would calculate that for every year. You could put together what's called a depreciation table here. So we can see what happens. Under straight line, the depreciation expense does not change. Our accumulated depreciation, well, is not going to change for each year, but accumulated depreciation will go up $9,000 each year because of the additional depreciation. So our book value, remember, cost minus our accumulated depreciation, is going to continue to go down until we get to salvage. We do not depreciate below salvage value. We can also modify that straight line rate a little bit, that formula that I gave you, by taking 1 over the useful life and multiplying that times cost minus salvage. So we call that the depreciation rate. 1 divided by the useful life. That will give us 20% depreciation per year. And we will use that when we do the double declining balance method. So you'll see the depreciation expense reported on the income statement remains the same, while our book value of that asset, cost minus accumulated depreciation, will continually decrease. All right, let's look at another method here, units of production. Sorry, this slide is a little hard to read. What we're going to do is calculate a depreciation expense per unit. So units of production would be good for things like copy machines, where the useful life can be set in units. So the number of copies, perhaps tractors run by the number of hours. We could do number of miles on a car. So that's how we would use units of production method. So we'll calculate a depreciation cost per unit, and then we'll multiply that times the number of units used during the period. So cost minus the salvage, just like we did for straight line, divided by the estimated total units to be made. Then we'll multiply that result by the number of units produced. So let's give you an example. On December 31st, 2004, equipment was purchased for $50,000 cash. The equipment is expected to produce 100,000 units during its useful life and has an estimated salvage value of $5,000. If 22,000 units were produced in 2004, what is the amount of depreciation expense? Okay, so first we've got to calculate that. I call it a depreciable cost per unit. So we'll calculate the cost minus the salvage, 45,000, divided by the total units expected to be produced, which was 100,000. That gives us a depreciable cost per unit of 45 cents. Multiply that times the number of units produced during the period, which they told us was 22,000 units. That would say our depreciation expense that year was $9,900. And we'll do one of those tables, and you can see. This is good when your units of production may vary considerably. See here, in 2006, they didn't use that piece of equipment at all, so we didn't record any depreciation. So if you have a good fluctuation, this may be a good method. So for 2004, our accumulated depreciation was $9,900. Book value went down to $40,100. They increased the units used during 05. We would still multiply that times the 45-cent depreciable cost per unit to get 12.6. Accumulated depreciation goes up by 12.6, and book value goes down by 12.6. All the way down again to that salvage value. We do not depreciate below salvage. So in the event that we would have had greater depreciation that year, we would have to adjust this depreciation expense so it doesn't exceed, our book value doesn't go below that salvage. Last one, we're going to talk about the declining balance method. So here we take 2 times that straight line rate, remember, which was 100%, or 1 over the useful life, and we'll multiply that times 2. And multiply that times the beginning book value. Well, here's the deal. Beginning book value is cost minus accumulated depreciation. So for a new asset, there is no accumulated depreciation. But every year that you calculate the double declining balance method, we need to adjust this number. Book value is going to be adjusted, and we need to make an adjustment for that. Let me show you what I mean here. On December 31st, equipment was purchased for $50,000 cash. The equipment has an estimated useful life of 5 years and an estimated residual value of $5,000. Looks familiar. Calculate the depreciation expense for 2011 and 2012. So in 2011, we're going to look at double that straight line rate. So 1 over the useful life would give us 20%, because 1 over 5 is 20%. Multiply that times 2, we'll get a depreciation rate of 40%. That depreciation rate does not change while we're calculating depreciation going forward on this. However, that book value will. So the beginning book value was $50,000. Cost minus accumulated depreciation. There was no accumulated depreciation, so it's just the cost. $50,000 gives you $20,000 worth of depreciation in the first year. Now in the second year, we're going to use that same 40% and multiply it times the cost minus the accumulated depreciation. Well, we had $20,000 of depreciation in 11 that we need to subtract now. So that will give us a 2012 depreciation expense of $12,000. So you see we take a big hit up front, and then every subsequent year the depreciation will get smaller and smaller. So here's what we would end up with if we did the math for every year. Here's a problem. See, we can't go below salvage. If we were to do this and take a full year's depreciation in 08, we would go below salvage value. So we have to adjust that. We cannot take $25.92 worth of depreciation in 08. We'll have to back it down so that our book value will stop at $5,000. Here's a comparison of the various depreciation methods. So straight line, you have a consistent amount of depreciation every year. Units of production varies depending on the use of the equipment. And double declining balance, we take a big hit early on, and then it gets a little bit less later on. A couple more quick things. You can see most companies do use the straight line method here. A couple of them will use units of activity. A few will use declining balance. And there's a couple of other possibilities that they can use there. So straight line is by far the most common. Also, just to let you know, for tax purposes, companies are required to use makers. So they will use one of the methods that we discussed, and then they will adjust their taxes. For their taxes, they will use makers. This is required by the Internal Revenue Service. They will tell companies, for this type of asset, here's how long you get to depreciate it. This is the rate of depreciation in year 1, year 3, year whatever. So if you ever have some free time, you can turn to the IRS webpage and pull up the depreciation manual. It's like 100 pages long. And they do ignore salvage, and then again, those useful lives are going to be set by the government there. So thank you.